Acquisitions and Input Tax Credits with Rachel O'Donnell. This session is brought to you live by Tax Nuggets Academy. So now to introduce our wonderful instructor. Rachel O'Donnell is the principal at O'Donnell Tax Law, where she specialises in indirect taxes, including GST, duties and land tax. So nice to see some love coming in already. Please put your emoji hands together to welcome back Rachel. Hey Rachel, how's it going?
Well, thank you, and thank you for having me again. And I also echo the sentiment. Thank you for everyone with the patience with the reschedule that we had to do from last Thursday. But good to be back on deck, and good to be kicking into the next GST Basics session.
Yeah, there's so much to GST, and this has really highlighted that you cannot cover it in 1 hour.
Absolutely not. Absolutely. There's definitely a lot to cover. So I might jump straight in, but first of all, I'd like to touch on a topic that we discussed last time. Just a couple of questions in relation to the deferred GST scheme. The first being, I'd mentioned that you need to be essentially a compliant taxpayer to be able to enter the deferred GST scheme. And the question was raised as to whether payment plans can cause a problem with that. So the ATO does recognise that payment plans are something that they allow to ensure that taxpayers can be and remain compliant. So having a payment plan doesn't necessarily stop you from being able to be part of the deferred GST scheme, but defaulting on that would, as you'd expect, be problematic. So if you default on a payment plan, then that can mean that the ATO might withdraw you from that deferred GST scheme. So that's consistent with the compliance obligations there. The other aspect is the amounts that are put into the BAS, the pre-filled amounts are actually given by Australian Border Force, and so that is entered in on behalf of taxpayers. So when you're doing it electronically, it'll come up as item 7A on the BAS. And so you need to actually go back through your customs broker if you use one, or through ABF, Australian Border Force, if there's any errors in that. So just as a reminder, the way it works is that amount is pre-filled as an amount of GST paid, which essentially just gets given to the ATO through that deferred GST scheme, and can be claimed back by that relevant taxpayer in the BAS. And we're actually going to have a look at some BAS forms, although most people don't use the forms that are physical forms these days, towards the end of this session as well.
So Rachel, I appreciate or expect that the pre-fill amount, if you actually make changes to that, like if you make changes to information that's been pre-filled in an income tax return, such as CGT amounts, you have to have some really good documentation if you're going to make the change, because that will certainly be flagged. Would that be your experience?
Yeah, so it is actually meant to go, any changes to that amount are meant to go back through ABF. So it's
okay, right,
on the back end, if you like.
Yep.
Opposed to being done through your BAS. So not meant to adjust that amount at all in terms of the pre-fill. It is meant to be something that you contact the ABF about.
Okay, right, so that they can make any adjustments?
Correct.
Right, okay, good to know. Thanks for that.
Different from most of the adjustments that we make, pre-filled amounts where there might be an amount that's different for some reason.
Okay, yep. Good to clarify that. So thanks so much for following up on those. Now let's talk about what's going to be covered today.
Yes, so we're going to recap the basic GST rules and concepts. So just to put the structure around what we're going to be talking about today, which is focusing on creditable acquisitions, claiming input tax credits, and creditable purpose. So those things are all sort of part and parcel of the same thing, which is claiming those input tax credits, and apportionment, where we've got situations where an acquisition is partly creditable, consideration, so touching in on this again for related party transactions, and just a reminder of some of the relevance of our associated persons provision in there. And then we'll be talking again about preparing a BAS. So going back over some of the content that we covered earlier on, and talking about some of the BAS lodgement admin, and then the actual attribution of input tax credits, and having a bit of a look at where we put things in a BAS, albeit that it is usually done electronically. So that's what we're going to be talking about today. So just to recap on the basic concepts, this is where input tax credits come into play. As a reminder, I like to think of there as being 4 types of supplies for GST purposes. those that are outside of their GST net because they don't meet the positive limbs of being a taxable supply. So, for example, if the supplier is not registered for GST and not required to be registered for GST, or if they're making the supply personally, so something like, selling their own home as opposed to selling property that they have built and developed into new residential, for example. So supplies that are outside the GST net, no GST is charged on those and no entitlement arises in respect of input tax credits. Taxable supplies is the next one. So those are supplies that we covered off previously where you have those elements of being a taxable supply. So a supply that is made in the course or furtherance of an enterprise for consideration where the supplier is registered or required to be registered for GST and where the negative limbs are not satisfied. So there's that element after that where it says except to the extent that those supplies are GST free or input taxed. And then the final two there, GST free supplies and input tax supplies, both of which are not subject to GST, but usually we can only claim input tax credits for GST free supplies, in respect of acquisitions that we make for the purpose of making GST free supplies or taxable supplies. For where we make acquisitions that relate to making input tax supplies, we've got an asterisk there because usually we can't claim those input tax credits, but sometimes we can, and we'll get to that in a little bit more detail today. So as a reminder, this is talking about the claiming of the credits for acquisitions that are made as opposed to the actual GST that you're charging. So if I look at a taxable supply as the simplest example, I charge GST to my clients when I provide legal advice. So the supplies I make are taxable supplies, they're subject to GST. The acquisitions that I make, I can claim an input tax credit for the GST component of those acquisitions that I make. So things like the GST that I pay to Officeworks, any GST that I'd have on rental premises, my PO box, any GST basically that I pay for acquisitions that I make in my business, I'm entitled to claim as an input tax credit. And we will now get into why and how that is the case.
I just want to ask, you've got ITCs there. Is there an issue with using ITCs? I've just gone through another tax handbook and it only referred to input tax credits. Is there a reason why sometimes the acronym is not appropriate?
Not that I'm aware of. It might be a preference. So it might be that the ITCs might be used as an acronym for something else as well. Is there anything that you're aware of, Nicole?
No.
I always refer to them as, or I often refer to them as ITCs, but it does depend on who I'm engaging with. So if I'm engaging with a less sophisticated client, I might refer to them as GST credits. I will usually say input tax credits, which are also often referred to as GST credits, just so they get an understanding of what I'm talking about. Talking to other tax people, I usually refer to them. I usually say input tax credits, but I'll usually abbreviate them in writing to ITCs. And in any advice that I give where I use ITCs, I will always define that within the advice before I start using them. Yeah. But there might be some that don't, because there might be other abbreviations where ITCs, they might refer to some sort of international company or something along those lines.
Yeah,
Might be that. A very good question though. It is. I have often seen it. Come to think of it, I think a lot of the things that I read in, it's not abbreviated that way. So something that I do, and you'll often see that in GST communications. That's an important point. So maybe be wary of using that outside the context of slides or somewhere where you've actually defined it. So, starting proposition is that taxpayers are entitled to input tax credits for creditable acquisitions that they make. And I put the section reference there. It's a pretty simple section. The amount of the input tax credits to which they are entitled is generally going to be equal to the GST that is payable on the supply of the thing that they have acquired. So as we've gone through before, so many terms are defined for GST purposes. So there we've got input tax credits, creditable acquisitions, and supplies are all defined terms or concepts within the GST Act, which, as a reminder again, is the ANU Tax System Goods and Services Tax Act 1999. And I've just put some section references in case you want to refer to them later on, but so it's more for the purpose of having them in the slide than really looking in detail at those particular provisions. So an entitlement to an input tax credit is reduced if the acquisition is only partly creditable. And so that's a defined concept that we'll get to again later. But generally you need to have a creditable purpose when you make an acquisition to be entitled to that input tax credit. So where you only have a partly creditable purpose, you're only partly entitled to an input tax credit. So there's a reduction in input tax credit to which the taxpayer is entitled. What we're talking about today is creditable acquisitions. We're focusing on creditable acquisitions under Division 11 of the GST Act. Division 15 deals with creditable importations. The concepts are much of a muchness. So when you're dealing with an importation rather than an acquisition, you look to Division 15, but the concepts are essentially going to put you in the same position because you look at the same things. Do you have a creditable purpose? To what extent do you have a creditable purpose? How much GST was involved? So creditable acquisitions. The way I've set this out is different than what you will see in section 11.5. And the reason for that is I like to start with, is it a taxable supply that you're acquiring? Because if it's not, then you don't have a creditable acquisition. That's the second element within that section 11.5. But I like to start with it because if you don't have a taxable supply, you can't have a creditable acquisition. So that's I think the easiest way to start. So as you all know, the GST language, the GST Act uses general language of you make a creditable acquisition. So I often refer to a taxpayer makes a creditable acquisition, but the language they use is you make a creditable acquisition if you acquire a thing solely or partly for a creditable purpose, which we'll get to in a moment, and the supply of that thing to you or to the taxpayer is a taxable supply. So you can see there that they're switched around. And you or the taxpayer, the relevant taxpayer, provides or is liable to provide consideration for the supply. And again, consideration is a detailed definition that we've gone to in a previous session. So it's broader than you might otherwise think. But you do need to have a nexus with the supply that's being made. And you, the relevant taxpayer, is registered or required to be registered for GST. So that's your starting point. You've got the positive elements there of you make an acquisition solely or partly for a creditable purpose. That acquisition or that supply to you is the taxable supply. You provide or are liable to provide consideration for that supply, and you're registered or required to be registered for GST. So acquisitions are defined in section 11.10 of the GST Act, and essentially they're the flip side of a supply, which is defined in section 9.10. There was a perfect word to use for this, but I've discovered that for me it's one of those words that I just cannot get my tongue around, the same way that Benedict Cumberbatch cannot pronounce penguin. It's not a complex word, but for me it's a tongue twister. So it's just easiest to think of it as the flip side of a supply is an acquisition. So,
can you write it in the chat box so we can all have a go?
It feels so silly because there's not a complex corollary.
Yeah, I'm not going to try it.
You'll know what I mean, but
I'll practice when we're finished.
It's not a complex word, but every time I go to say it, I have a giggle at myself, and so I thought flip side works just as well. So an acquisition is any form of acquisition whatsoever. So again, it's a very, very broad concept, but in effect, it becomes limited because to the extent that you're dealing with acquisitions, when we get to the creditable acquisition aspect, it needs to be a taxable supply. So although this is broad, it then becomes a bit more limited to things essentially that are a taxable supply. So any form of acquisition whatsoever, including an acquisition of goods or services, the receipt of advice or information, the acceptance of a grant, assignment or surrender of real property, and we'll get into real property in our next session in a bit more detail, the acceptance of a grant, transfer, assignment or surrender of any right, the acquisition of something, the supply of which is a financial supply, and we'll talk about financial supplies in the final session next week, the acquisition of a right to require another person to do anything, to refrain from an act, or to tolerate an act or situation, or any combination of one or more of the above. So basically that aligns it with supplies, so that if you have a supply that meets the elements to be a taxable supply, then the recipient of that supply, so the acquirer of that supply, should be entitled to an input tax credit, provided they satisfy the other requirements in terms of creditable purpose to make it a creditable acquisition.
I'm just going to add to that list, because what I do, I don't know if anyone notices, but what I do is I always kind of look things up as you're kind of going through them. So I had a look at both of those sections to see if that is there. But what I noticed is the last point, number 4, in both of them, I think, is a supply of digital currency too.
Yes. Sorry, that's a more recent addition.
Yeah.
So that's one that was not in the version that I've pulled out for the purpose of these slides. But yeah, very, very good point, because as we're needing to amend and update the law, we need to deal with these concepts of, what is digital currency and how we're dealing with digital supplies and whatnot, which is a very, very, very complex area. But yeah, very good point as well. And so creditable purpose. So to make a creditable acquisition, we need to have a creditable purpose. And a taxpayer has a creditable purpose to the extent that the taxpayer acquires the supply that they've acquired in carrying on their enterprise. That's kind of your starting point. And a reminder that we talked about carrying on an enterprise in the first session, I think it was, in quite a bit more detail. So you do need to make that acquisition in carrying on their enterprise. So what that means is, for example, I'm registered for GST, but if I go to Officeworks and buy some printer paper, and I also buy some art supplies for my daughter, the way I deal with it is I actually get out separate credit cards and I pay for my business expenses on one, so I have a receipt that is purely for taxable supplies to me that I know I have a creditable purpose for. I know I'm acquiring them in carrying on my enterprise. The art supplies, I don't have a creditable purpose for, because I'm not acquiring them in carrying on my enterprise. I'm acquiring them in my capacity as a mum, and so I keep it separate that way. So that's kind of a good way to think of it. So are you acquiring it for the purpose of doing your business things? Keep in mind, obviously, enterprise is broader than business.
That's very smart. Don't we wish that all our clients actually kept their business and their personal expenses separately?
Yeah, and I do find it's the simplest way to do things where it is possible, but it is not always possible, particularly to the, because we've got all these concepts throughout the GST legislation of things being to the extent that, and the acquiring the one thing and receiving one tax invoice for something that is partly for business or enterprise purposes and partly for private purposes. So sometimes there is a need to sort of go into that apportionment for that reason. But yeah, definitely, if you can, to keep it simple, best to do it that way. And I've got but there. So that's the positive limb. And then we get into the negative limbs of, but it's not to the extent that the acquisition, sorry, that should be coming up. Yeah, not to the extent that the acquisition relates to making supplies that would be input taxed. So this is the starting point, and we'll see there's some adjustments after this on that point there. And also not to the extent that it is of a private or domestic nature. Now, there's lots of argument about this because there's an overlap, if you like, between something being of a private or domestic nature and something being not acquired in carrying on your enterprise. So arguably part of the reason that second negative limb is in there is to make it abundantly clear that if it is private or domestic in nature, it comes out and is not an acquisition for which the taxpayer has credible purpose. But usually, in my view, in everything that I've looked at really, if it's of a private or domestic nature, I think is probably out under the first limb anyway. It is just that sort of catch-all to ensure that anything that where there's a bit of doubt, the Commissioner likes to be able to hang his hat on that negative limb as well and say, well, it's clearly out for that reason. There are some exceptions to what we've just talked about here, and those are exceptions to the input tax negative limb. So acquisitions are not treated as related to making input tax supplies to the extent that the supply is made through an enterprise or part of an enterprise that is carried on outside the indirect tax zone. So what that means, for example, is if I am carrying on an enterprise that makes supplies outside of Australia that would be input taxed, I can ignore those for figuring out whether I've got a creditable purpose. And we see that throughout the GST legislation for various aspects, that certain supplies that are made do get sort of ignored for those purposes. We see that in some of the thresholds, the GST registration thresholds and whatnot. And so that's one of the ones that comes out here. The next one is...
Rachel, sorry to put you on the spot with this one, but could you actually kind of give an example of that first scenario there? So where the supply is made through an enterprise carried on outside the indirect tax zone?
So if I have a business that, just to give a simple example, if I have a business that makes supplies of residential rent in Australia, and that residential rent, and actually I'm glad you pointed this out, because I'll get to some of the specific wording that is in there as well. The supplies of that residential rent in Australia would be input taxed. So that is something that comes within that negative limb and blocks my input tax credit. To the extent that I am making supplies outside of Australia, that because the wording in the legislation is actually that would be input taxed. So if I make supplies of residential accommodation outside of Australia that would be input taxed, those things are taken out of those things are disregarded for the purpose of this test. So if I make supplies of residential accommodation in Australia and make supplies of residential accommodation overseas, and also, when I say accommodation, I should say residential rent that is clearly, if I make those things both in Australia and outside of Australia, and I also make supplies of commercial rent in Australia, it's only the Australian residential component that would require a reduction of an input tax credit.
Okay, so you're saying that the supply of the residential rental property, for example, let's say New Zealand, doesn't actually require a reduction of the input tax credit?
Correct.
Right, okay.
Yeah, so it is, and that's partly because things outside of that net sort of start to fall outside of it. It's sort of harder to monitor what's going on overseas, and some of those things are just, they're excluded. So we look at, and it's partly because, as I said, because of the language of the legislation talks about supplies that would be input taxed. So also supplies that are made overseas that are financial supplies that would be input taxed potentially come out as well.
Okay, thank you.
It's not one that I see much in practice though. It's more the other two elements of this exception that I see in practice a lot more regularly, and the ones that really need to be kept in mind, because this is where I've seen people go down rabbit holes for input tax credits and claiming of input tax credits, where they get scared because what is being acquired relates to making financial supplies. Once you're making a financial supply, you don't just stop at its input tax. You need to look at these two provisions in particular further. So it's not treated as relating to making input tax supplies, where it relates to making financial supplies and the taxpayer doesn't exceed the financial acquisitions threshold. So we'll talk about the VAT and financial supplies in further detail on during our last session, which is next week. But essentially what that means is if I make if I don't exceed the financial acquisitions threshold because I'm not making lots of input taxed acquisitions of financial supplies, then I don't need to manage it and monitor it carefully and work out lots of different proportions. So what this is about is it's a de minimis threshold essentially, and it's meaning that people like me that do nothing or almost nothing but make taxable supplies don't have to worry about little bits and pieces of acquisitions that I make, to the extent that I might, for example, charge a client interest because they have been late on payment of their invoice and those sorts of things.
So the charging of the client interest is an input tax supply, but you're saying it wouldn't exceed the financial acquisitions test, so therefore you don't have to limit your input tax credits in relation to that supply.
Correct.
Yep. Okay.
Yeah. So what it does is it means that it puts most people into a more practical scenario where you do need to be careful of the financial acquisitions threshold, and we'll talk about that in the last session as to why you need to be careful of it, because I have seen taxpayers, particularly where they have a big one-off transaction, that can cause them problems with the VAT. But it just means that most taxpayers, to the extent that you're not in the financial space, you then don't have a problem with limitations on your input tax credits as a result of that. And the last one there is a similar concept. So where you make an acquisition that relates to making financial supplies consisting of borrowing, and the borrowing relates to making supplies that are not input taxed, then those input tax credits are not denied either. So for example, if in my business I need some more funds and I obtain more funds and I go to, for example, a non-bank provider and I get a lawyer that does provides financial legal services to draw up the loan documentation. When I pay that lawyer for drafting that loan agreement and I pay that GST, I can still claim that GST that I paid to that other lawyer for drafting out that loan agreement, because it relates to a borrowing, and the borrowing relates to me making supplies that are taxable supplies. Because
your taxable supplies, yep.
Yeah. But it is important to flow that through. So if I'm actually making input tax supplies and not just taxable or GST-free supplies, then that making of those input tax supplies can taint that borrowing as well. So it brings you back to the position of kind of other normal acquisitions, if you like. But again, it means that if you're just in the business of making taxable and GST and or GST-free supplies, it keeps it that little bit simpler. So we have our first case study today. We've got Phoebe here, and anyone that's been following along might recognise Phoebe as Phoebe Buffet, or potentially Phoebe Buffet, I should say, from Friends. So Phoebe carries on a massage therapy business. She has an ABN and is registered for GST, keeping in mind that that registered for GST point is what we talked about in the very first session. So Phoebe rents a treatment room in which she provides massages to customers. Is she entitled to claim an input tax credit for the GST included in the rent?
Okay, so I just want to check the question here. So Phoebe, when it says Phoebe rents a treatment room, so Phoebe's paying the rent of that treatment room, and in that treatment room is providing massages to customers. So is she entitled to claim any input tax credit for the GST included in the rent? Okay, so this is our first quiz for the day, and in the chat box there is the link, or you can use the QR code on your screen to actually get into Slido so that you can vote. People are already there. Well done, so impressive. Very impressed with that. So it's really just a yes or a no. Yes, Phoebe can claim the GST as an ITC, or no, she cannot claim the GST as an ITC. We'll just give you a few more seconds to vote. I'm obviously not familiar enough with Friends. Clearly did not spend enough time in my younger years watching it. Could never have recognised that surname.
I think in Friends she's actually an employee most of the time, but in this instance I'm making her the business owner.
Yeah, fair enough. I mean, things have changed since then, yeah?
Okay.
All right, thanks so much. There's so many that have voted. I really appreciate that, but I will just close it off in a couple of seconds. So jumping quickly Hopefully you've been able to connect. It doesn't take very long once you use those links. And let's just see how everyone's gone. Mostly everyone's saying yes. It looks like that is correct.
Yes, so that's where we get to. So she is registered for GST and she's carrying out an enterprise. So she's acquired that treatment room, essentially, is what we're looking at here. She's acquired that treatment room in the course or furtherance of carrying on her enterprise. She's using that acquisition of the room to be able to make taxable supplies of providing massages to her customers. So the next question is that her employee uses a separate treatment room at nearby premises when required for additional massage clients, and the employee uses their own premises but is not registered for GST. So Phoebe pays rent of $220 per month to the employee for use of that second room. This is less than the market rent, which would be $330 per month, including GST, if any. Is Phoebe entitled to an input tax credit in respect of the rent? So this is the rent that she's paying to her employee to use their room. She's paying $220 even though it's worth $330, and she's paying that to her employee to use that room.
All right, a few concepts here. I remember if you've got the slides, you can actually don't look at the answers, but you can look at the information there if you kind of need to reread it. But these are the potential responses. Yes, she can claim an ITC of $30 per month, or yes, she can claim an ITC of $20 per month, or yes, she can claim an ITC of $10 per month, or no, she cannot claim any ITC. So good to see a few answers come in already. This might be a little more, that require a little bit more thought, this one. So Phoebe's paying rent for the use of effectively her employee's premises to conduct additional massages when things are getting busy. Phoebe's paying $220 per month. The market rent is $330 per month. The employee is not registered for GST. I'll just give you another couple of seconds. And we'll just close it off now.
Oh, I got scared initially because I didn't realise the bottom one had moved up to the top there. But it's good to see that most people have recognised that she cannot claim an input tax credit. And the reason for that is because her employee is not registered for GST. I probably should have put nor required to be registered for GST, I think, in the background facts. But essentially, because it's being supplied to her without any GST in that $220 that she's paying, she's not entitled to an input tax credit. Because remembering, claiming the input tax credit is about claiming back the GST that is paid in respect of the acquisition that you have made. And I should have probably said no required to be registered either. So we might give a little bit of leeway to the people that had said $20, because if she was registered for GST or required to be registered for GST, so that the acquisition included GST of $20, then you'd be looking at a $20 input tax credit claim for Phoebe. How
do you assess that, Rachel? Like how would you assess? Actually, that person that I paid for this particular service or good should be registered for GST, so I'm claiming it. So how do you manage that?
A tricky one. Essentially without communication. So when are required to be registered, that's where it does get really, really tricky. And I think we've talked about this in a different session as well. So where they are registered for GST, it's much easier to be able to look it up on ABN Lookup to see that they are registered for GST as kind of your starting point. Got substantial transactions, so they're very big dollars. If ABN Lookup doesn't say what you expect it to say, and or if you think there's a possibility that the supplier might change their GST registration, for example, by registering after getting into an agreement, or by cancelling their registration with retrospective effects, so looking to make them change there, then you might want to ensure that you've got some warranties and indemnities in your contractual arrangements to cover off the situation to address the GST treatment. But essentially, it boils down to if they are not registered for GST, and you have no reason to think they should be registered for GST, then because you've got to hold an hold a tax invoice to claim your input tax credits, which we'll get to in a moment. That's a good way to find out, is to ask for a tax invoice.
Well, Parag actually just made that comment in the Q&A. Is it not necessary to have a tax invoice? If not registered, the employee cannot issue a tax invoice.
Right.
Yeah, so like if someone was quite sure that someone needed to be registered and perhaps felt that, they weren't registering for, perhaps mischievous reasons, but they were going to claim that GST, perhaps it's quite a large purchase, for example, would it be a problem that they didn't have a tax invoice, they only had an invoice?
So the starting point is yes, it would be a problem. You don't have that valid tax invoice to be able to claim back the GST. The Commissioner does allow some discretions in certain circumstances, but the starting point there would be if you've got a substantial dollar transaction and you've got concerns about it, then what you should be looking to do is in the contract say that the payment of the GST component is dependent upon the supplier providing a valid tax invoice. So actually don't give them the GST component unless and until they've given you a valid tax invoice.
Okay, so only give them 10/11th of the invoice that's provided, is that what you're suggesting?
That's correct, yeah.
Mm-hmm.
So that's not a legislative concept,
yeah.
a contractual concept, so they do need to contractually have to adhere to that. It is different to the legislative concept, which is just that a supplier has to give a valid tax invoice within 28 days of a request by the 28 or 21 of the recipient of that supply.
Mm-hmm. Okay. All right, and thanks for clarifying that. There's so many little.
There's lots of little, yeah.
What do you call it?
That is a tricky one because I have seen people have tried to cancel their GST registration after everything's been bedded down, and it puts the recipient in a tricky position if they haven't got a contract that locks the supplier into that position. And the starting point is the price includes GST, if any, unless your contract says otherwise. So if your contract is silent as to GST, and I've seen it where a contract will be silent as to GST, the purchaser thinks they'll get an input tax credit for 111, the vendor cancels their GST registration or is just not registered, and the purchaser, and assuming they're entitled to be not registered for GST, and the purchaser then is not entitled to their tax credit. So it's important to make sure on the big dollar transactions that it's absolutely covered off.
Yep, great. Thank you.
We'll see. So, thank you. So the input tax credit, the starting point is it is the amount of the GST that has been paid in respect of that acquisition. So again, it has to be a taxable supply to be able to claim an input tax credit. If it's not a taxable supply, then there's no GST payable, so you don't get an input tax credit. The starting point is the input tax credit for an acquisition is the amount of the GST in respect of that acquisition itself. And a reminder that there's a ruling there on the apportioning of consideration for a supply that includes taxable and non-taxable parts. So where you've got a supply that is partly taxable and partly non-taxable, so a mixed supply, then the supplier should look to that ruling and use any appropriate apportionment methodology with substantiation in case the ATO looks at that. On the recipient side, we then need to do some apportioning in circumstances where we have a partly creditable purpose and in some other circumstances that we'll get to in a moment. So if I'm acquiring a taxable supply partly for a creditable purpose, then I need to determine the extent of my creditable purpose. And we'll talk about how we do that in a moment. It's worth referring to this particular ruling from the ATO, which sets out their views on the matter. There's also a number of other situations where there's a specific ruling or a specific determination. So in a real property context, there's other guidance from the ATO as to their views on how you make that apportionment. We'll talk about that a bit more on Thursday when we're talking about real estate transactions in particular. So the apportionment where it's partly creditable. So you've got a partly creditable acquisition where the acquisition that you make as a taxpayer is only partly for a creditable purpose, and or if you only provide or are liable to provide part of the consideration for that acquisition. So if I make an acquisition and I am liable for part of the consideration, but someone else is paying another part of the consideration, and this might happen sometimes in the context of kind of subsidised transactions, then I've only got a partly creditable acquisition. So there's the two elements there where we can have a partly creditable purpose and a part input tax credit. In those situations, the input tax credit is equal to the full input tax credit, so the GST component of the acquisition, multiplied by the extent of the creditable purpose that I have and the extent of the consideration that I provide or am liable to provide. And the extent there, they're both percentages. So the full input tax credit is the GST included in the taxable supply that I have acquired. The extent of the creditable purpose is the extent to which the acquisition is for a creditable purpose, expressed as a percentage. So, for example, if I acquire something, 50% for personal use and 50% for use in my business, and my business makes fully taxable supplies, then I've got a 50% creditable purpose. So the starting point is I multiply it by 50% there. And the extent of the consideration is the extent to which I am liable to provide that consideration. So, for example, if I have an acquisition of a taxable supply that's $11,000, the GST component is $1,000, so 111 of that amount there, and I have a creditable purpose of 50% because I'm acquiring it 50% for my business and 50% for the purpose of making taxable supplies. Then the starting point is I bring my input tax credit down to 50%, so down from 1,000 to 500. And if the extent of the consideration that is provided is, say I'm providing 80% of the consideration, and for some reason there's a different person that is providing the other 20%, then the extent of the consideration is 80%. So there I'd start with my $1,000 input tax credit, I'd multiply it by 50% to get to 500, I'd multiply it by 80% to get to 400. So it is worth working through that. We see the extent of creditable purpose being relevant far more often than the extent of consideration, but it is just worth keeping in mind if you have anyone other than the relevant taxpayer providing some of the consideration, you need to determine whether they are doing so as agent. So if it's just a flow of funds matter where the money's coming from Nicole, but it's fallen on my behalf and it's just the way it's actually, it's just the way it's sort of documented or transacted. If it is actually me providing it out of my pocket, but you've sort of got some flow of funds that mean it's come via Nicole, then that might mean I still have a 100% extent of consideration. But if someone else is liable for it rather than the taxpayer, then that reduces the extent of the consideration provided by the taxpayer.
I wonder if that actually happens in farming communities, for example, when you're buying, really, big, expensive machinery, and there might be some kind of sharing arrangement with nearby farmers. You might see something like that.
Yeah, absolutely. And so, and that can be relevant as well, where similar sort of situation where you're sharing acquisitions, and it might be that, or any sharing of acquisitions essentially. So you can have the two aspects. The acquisition being made partly by multiple parties could be treated that way, but also if someone else is liable for the consideration instead of me.
Yep.
So the next point that I wanted to raise, and we talked about this previously in the context of consideration for GST purposes and the making of taxable supplies. So the supplies between associates for no consideration or for inadequate consideration, under Division 72 of our Act, are not stopped from being taxable supplies, GST-free supplies, input tax supplies, or financial supplies. And relevantly here, they're also not stopped from being creditable acquisitions. So that plays into the input tax credits here in a way that we'll talk about in in just a moment. The supplies between associates, as a reminder, our definition of associates takes you back into the 1936 Act, the Income Tax Assessment Act 1936, section 318, and the definition there. So that does mean that some associated persons, if you think of that as a general concept, are not within that definitions of associates. So if you have a transaction for no or inadequate consideration, you need to consider whether the parties involved are associates as defined. If they are, then you need to consider whether Division 72 applies. And Division 72 applies in circumstances where the recipient of the supply is not registered or required to be registered for GST, or acquires the acquisition wholly or partly for a non-creditable purpose. So what that means, you might see that feels a little bit familiar here. So if your recipient would not be entitled to a full input tax credit, is what that provision really boils down to, then you have this provision kicking in here. So if I've got deemed consideration that causes a supply to be a taxable supply, when I'm making when I'm making an acquisition of that supply, then I am not denied an input tax credit. The effect of this is I'm not denied an input tax credit to the extent that I do have a creditable purpose and am registered for GST. So obviously, if you're not registered for GST and not required to be registered for GST, you don't have a creditable purpose. But if you have a partly creditable purpose, that's where this reinstates, if you like, your entitlement to an input tax credit. So if I assume that Nicole and I are associates, we wouldn't be, but if we were associates within the definition, and I make a supply to Nicole that she uses in her business, but because we're associates, we're on good terms, I make that supply to her for less than full market value consideration. She's going to use it in her business, but she's actually only going to use it partly for a creditable purpose, because Nicole actually makes input tax supplies as well. So she'd only be entitled to a partial input tax credit. The ATO says, well, they want as much GST as they can, so they deem that supply to be made for full market value consideration. Going back to the earlier session, we've got deemed market value consideration being provided there. And then Nicole is entitled to an input tax credit based on that deemed market value consideration, and is entitled to, she's still got a creditable purpose for that to the extent that she otherwise would have.
And also for yourself, you've got
Absolutely, on the supply side,
yep.
I have to gross up to market value.
Yep. I just wanted, I'm sure this is the case, but sure the extension of that is, if I wasn't registered or required to be registered, then actually perhaps if I did it the other way around, like if you were acquiring something, you're acquiring something from someone who wasn't registered or required to be registered, they were an associate, whilst there's deemed market value, you're actually still not entitled to that input tax supply because that supplier is not required to be registered.
That's right. So if you are acquiring from an associate who is neither registered nor required to be registered for GST, then Division 72 has no role to play.
Right, yeah.
Because even though it is deeming there to be consideration, it's still not a taxable supply because it's still one of the positive elements of 9.5, one of which is the supply registered or required to be registered for GST. So that's absolutely right. So this provision really comes into play in circumstances where you've got a recipient that's not entitled to a full input tax credit is sort of your starting point. Comes into play.
Yep, I see.
Yep, absolutely. So back onto our case study. So as well as providing massages, Phoebe loves to play the guitar, and she loves to sing about her observations regarding the world around her. And anyone that is familiar with Friends will understand that that song's like Smelly Cat. she provides free lessons. So she purchases two new guitars, one with a cat on it for personal use at home and a pink one to use during her lessons. Is she entitled to claim an input tax credit for the GST included in her purchase?
Okay, so quiz time again. So hopefully you're all connected to Slido now. So is Phoebe entitled to an input tax credit or an ITC for the GST included in the purchase? Yes, she can claim the whole of the GST as an input tax credit. Or no, she cannot claim any GST as an ITC. Or yes, she can claim the GST included in the price of the cat guitar. Or yes, she can claim, did I say yes in that third one? Anyway,
Right.
yeah, it's supposed to be yes. And the last one, yes, she can claim the GST included in the price of the pink guitar, which is the one used for the lessons. So
that's right. So the cat guitar is used by her personally, and the pink guitar is used to provide lessons.
I don't know if you can hear in the background, and like I don't know if you see me, I have to keep opening and closing the door for my cat, and she's just started meowing very loudly in the background. She obviously knows the word cat.
Yeah.
All right, just a couple more seconds, and we'll see what the results are.
Oh, good to see that most people are on track there. So, no, she cannot claim any GST as an input tax credit. So I did put this in as a little bit of a curly one, and the reason I did this is because Phoebe's registered for GST, and she's making supplies, and she's providing a service. But we don't just look at the input tax credits kind of in a vacuum, if you like, because she doesn't receive any income from providing these lessons. So importantly, she's providing these lessons for free. She's registered for a massage business, but she's not carrying on an enterprise of providing guitar lessons.
Can I ask, even if she was charging a fee, could it still be a hobby that she's just,
Potentially.
and doesn't actually kind of reach that level of being an enterprise?
Absolutely, yeah.
Yep.
So, and you might recall, again, with the requirement to be registered for GST and whether someone is carrying on whether an entity, which can include a person who's carrying on an enterprise, where the relevant entity is an individual or a partnership that is mostly individuals, then to have those activities constitute an enterprise, there has to be a reasonable expectation of profit or gain.
Yep.
And so
Which probably, Rachel, I think I probably jumped ahead a bit. It takes us to our next case study or to the slightly different facts.
That's right.
Yeah.
So I flip it around a little bit here, but that's exactly the reason, yeah. So if it's a hobby or if it's with no reasonable expectation of profit or gain, and Phoebe's an individual here, then her guitar activities are not an enterprise, so she's not entitled to an input tax credit for that purpose. But if we say as above, but in this situation, she does charge for her lessons and she does generate a profit, and just to avoid any doubt as to whether it's a hobby, I've said there that her accountant has advised her that her guitar lessons do constitute carrying on an enterprise for GST purposes. So we're saying now that the provision of those lessons is an enterprise activity. If that's the case, would she be entitled to claim input tax credits for the GST payable in respect of the guitars? So just mixing up the facts here.
Yeah, so time to vote again. So the options are yes, she can claim the whole of the GST as an ITC. No, she cannot claim any GST as an ITC. Yes, she can claim the GST in the price of the cat guitar. Or yes, she can claim the GST included in the price of the pink guitar. So just give you a few seconds to answer because slang there, we do have quite a few more slides to get through and only just over half an hour, so we'll have to keep moving along. So just a few more seconds to answer.
Just as we're saying that, I was talking about the tax invoices before and that requirement for the supplier to provide a tax invoice upon request. It is 28 days.
Yeah, actually pop that into the chat box.
Okay, good.
Right, yeah. Section 29-70, subsection 2.
And my brain switched back to a different time frame, totally different. and it took me a minute to register whether it was 21 or 28, but it is.
Yeah, no, that's fine. There's so many things like that. You just, you always need to check. All right, let's have a look at the results here.
Pink guitar. So we've got some saying she can't claim any, and we've got most people saying that she can claim in respect of the pink guitar. So I would say yes, she should be able to claim that in respect of the pink guitar, provided she holds a valid tax invoice. And then we can talk about attribution shortly as well. But in respect of the cake guitar, that is private expenditure in respect of which she should not be claiming an input tax credit for the GST component.
I mean, I don't know. She uses it in a practice. She uses it to maintain her skills. I'm going to challenge that one.
There would be. So that's why I tried to keep it very, sort of a lot more sort of clear there. I know that people would be pushing it. And I've tried to keep it as a sort of a simple, fun example. But there's certainly merit in saying that although she plays it for fun, and certainly the more active her business is and the more talented she needs to be, perhaps a little tongue-in-cheek for those who are familiar with Fred, then the more that is actually used in her enterprise, albeit that she does do that sort of in her personal time, essentially.
Yeah.
But it highlights the sort of things that we need to consider here. So we're going to talk a little bit more now about the BAS. So input tax credits and claiming of input tax credits, the way we do it is through the lodgement of the business activity statements by the taxpayers or their BAS agents or tax agents. So we've talked previously about the various tax periods. So taxpayers can potentially be registered on a quarterly or annual basis. For GST, annual is not particularly common because that's generally going to be where you're not required, where you've chosen to register for GST, but you're not required to be registered for GST. And you can go back into an earlier session if you'd like to delve into more detail about those tax periods. But the way that GST works is we look at the BAS and we put net amounts in the BAS to the extent that the GST that we need to give to the ATO exceeds the GST we can claim as input tax credits, then we have a net amount payable to the ATO. To the extent that our input tax credits exceed the GST that we need to give to the ATO, then we can potentially get a refund, or it might be offset against other liabilities that we owe to the ATO there. And we've previously also talked about cash and non-cash accounting or accruals accounting for GST purposes, which is particularly relevant for attribution for GST purposes. And again, there's a threshold there's a cash accounting threshold, and there's various other reasons for which people might be able to adopt a cash accounting approach rather than an accruals accounting approach. And as a reminder there, you look at things like sort of what business systems do you use, what accounting systems do you use, what is sort of normal practice in the area. So once we have talked about that, we'll touch on the attribution for GST and then focus on the attribution for input tax credits. So this is a little bit of a refresher on this side of things. As a reminder, a cash taxpayer accounts for GST based on the consideration that they receive as and when it is received, and an accruals taxpayer accounts for the GST on supplies they make. Supplies they make. They account for GST for the whole of their GST attributable to taxable supplies they make in the tax period in which any of the consideration is received or an invoice is issued if it's earlier. And as a reminder, that can be an invoice that is not a valid tax invoice. So that's basically an invoice saying pay up. It doesn't need to specify the details that are required to make it a valid tax invoice. It doesn't need to be a valid tax invoice. So cash taxpayers, when they make supplies, as and when they receive consideration, 1/11 that goes to the ATO. And just for completeness, that even includes if you have a document that says you give me the GST, acquirer, you give me the GST at this point in time. The ATO doesn't care about that. They just care about when you're receiving various amounts, and 1/11 of those amounts gets given to the ATO in those relevant periods. And for accruals, so non-cash taxpayers, the whole amount is attributable at once, and that's on the earlier of the issuing of an invoice or any consideration being received. attribution, so on the attribution side for input tax credits or ITCs, the starting point here is no one is entitled to an input tax credit unless they hold a valid tax invoice and the recipient has made their acquisition for a creditable purpose.
So we've got a difference here. Like if you're actually receiving consideration, you don't need a tax invoice for it to be required to be attributed or to be included, but to claim your ITC, it must be a valid tax invoice.
That's correct. So when you're giving money to the ATO because you've made supplies, you don't need to have issued a valid tax invoice, but if you are claiming money back from the ATO, you need to be able to have that valid tax invoice to be able to verify that you've made that acquisition and the amount of the GST included in that acquisition, and you also need to have the creditable purpose that we've already touched on today. So that's the starting point for all taxpayers, regardless of whether you account on an accruals or a cash basis. And then the timing of the attribution differs depending on whether you're an accruals or a cash taxpayer. So for cash taxpayers who hold a valid tax invoice and have made a creditable acquisition, they claim their input tax credits through their BAS as and when the consideration is provided. So if you pay 50% now and you pay 50% in the next tax period, the next BAS period, then you claim 1/11th of that 50% now and 1/11th of that 50% in the next tax period. So it's a pretty simple approach to adopt. It's money out the door. You claim it as that money goes out the door, but have to have that valid tax invoice to be able to do that and have to have the creditable purpose. In contrast, this is where we get a bit more limit. Sorry, that's me now. For an accruals or a non-cash taxpayer, the whole of the input tax credit is attributable at the one point, so in one tax period, and that tax period is the earlier of the period in which an invoice is issued or any of the consideration is provided. So there's some alignment with the supply side here. Here I've said the invoice is issued. You might remember for suppliers it doesn't need to be a valid tax invoice. Here, in effect, it needs to be a valid tax invoice, because if you don't have a valid tax invoice, then you can't claim your input tax credit anyway. So in effect, you need to have a valid tax invoice, but it's attributable, and it's attributable when any of the consideration is provided. So it's you do have a bit of a difference there.
But kind of in practice, it's only when you have a valid tax invoice, because if you've provided the consideration but you don't have a valid tax invoice, you're not entitled to claim that ITC at that point.
That's
right.
That's effectively true. But if you've got an accruals taxpayer, it's also worth remembering the whole of the consideration is attributable to that one tax period as well. But because you need to have your valid tax invoice, the exception is if you've got a situation where the commissioner says, I'll allow you to treat something as being a tax invoice instead. But in effect there, you'd still need to have some of the consideration being provided. And that's why on those bigger dollar transactions, it's important to try and align the treatment and say, well, supplier, if you want your money and you want me to hand over the GST amount, I want to be able to claim that input tax credit as soon as possible. Rather than waiting that 28 days after making the request, you align the payment entitlement with the provision of a valid tax invoice. So that you're ensuring that there's no delay in being able to claim an input tax credit. But you do have a difference if you've got, you do sometimes have a difference if you have a supplier who is registered for GST on one basis, so either a cash or accruals basis, and your recipient is registered for GST on the other accounting method. So there can be a difference there. Worth keeping in mind, particularly if you've got a situation where you've got an accruals taxpayer or non-cash taxpayer who has to pay some of the consideration, they'll be able to claim an input tax credit before they provided the whole of the consideration. So there can be an earlier claim. On the supply side, your vendor that's registered on an accruals basis they can be caught out. So if they're getting payment of part of the consideration and it's a long time before they get the rest of the consideration, they still have to give all of the GST to the ATO at that earlier point. So that can really catch taxpayers out if they don't realise that's the case.
Yep.
All right, so moving back to Phoebe. So she accounts for GST on a cash basis and lodges her BAS quarterly. As above, she rents a treatment room, so she's the tenant of that treatment room in which she provides massages to her customers, and she pays rent generally on the 15th of each month, and she does that on the 15th of March, April and May, as well as July. But in June, there was a glitch in her automatic payment, and she ended up having to make a manual payment for her June rent, which was made on the 2nd of July. So the question here, reminder, she accounts on a cash basis and she lodges her BAS quarterly. The question here is, she lodges her Q4 BAS, so her April to June BAS or her June BAS on the 16th of July. What input tax credit can she include in her Q4 BAS for this for the GST component of this rent?
So with this question, Rachel, can we assume that she is holding a valid tax invoice?
Yeah, very good point, and I have written that on my notes here. So, but we're looking at the screen, so thank you. Yes, I can assume she's holding a valid tax invoice.
Yeah. All right. So again, use the slides that are linked to the that are available in the chat box if you need to kind of go through the facts again. But we just need to know what amount of the input tax credit can be claimed, if any, in quarter 4 BAS. So quarter 4 being April, May, June. So is it 500, 400, 300, I'm about to take off, 200, 100, or nil? Start voting. There's a link in the chat box. If you haven't yet registered for Slido, maybe jump in at this point because we have a few more slides or quizzes coming up in relation to our case study. So if you haven't registered, please do so. Use that link that's in the chat box or use the QR code. So just, hopefully you can go back to the information there. March, April, May, 1,100 paid on the 15th of the month. June rent should have been paid on that day. Something glitched, ended up being paid on the 2nd of August. July rent was paid on the 15th of July. All the amounts of 1,100. So let's have a look now what the results are.
200. That is terrific to see that people are on track because she accounts for GST on a cash basis. In the Q4 quarter, she paid $2,200 of rent. It doesn't matter that she should have paid $3,300. That's what she pays. That's what she's liable for. That's what she's meant to pay each quarter. She only actually paid the $2,200. So she's only actually entitled to that $200 being 1/11th of the price that she paid. She's entitled to that in respect of her Q4 BAS. Next, we will mix up the fact pattern a little bit. So still she accounts on a cash basis and she lodges it quarterly. As above, she rents it and she pays the rent that way. But the difference here is we assume instead that she lodges her BAS on the 10th of August. So she's lodged it after she's made that 2nd of August payment. Does she lose the $100 entitlement for the $100 input tax credit for her June rent? So we've got a couple of different options there.
Okay, so assuming I'm going to figure this out myself. So assume instead that Phoebe's lodging her Q4 BAS on the 10th of August. I'm actually not sure what you mean by does she lose the 100 for her rent, but let's read through the responses. No, she can claim it in her September BAS. Oh, I see. Right, yep. Or no, provided she hasn't lodged her Q4 BAS before she makes the payment on
The 2nd of August.
2nd of August, she can claim it in her Q4 BAS. Oh, makes the payment of the rent, yep. Or no, even if she already lodged Q4, she can amend her Q4 BAS after she makes the payment in August. Or yes, she will lose the input tax credit. Okay, so I see what you're saying. You're basically saying that amount related to June but she didn't actually pay it until August. And so because she didn't claim it in her Q4 BAS, even though it related to that period, has she now lost the opportunity of getting that input tax credit?
Correct.
Yeah. So, has she lost that opportunity? Does she lose that $100 input tax credit? It's either no, she can claim it in September, no, provided she hasn't lodged the BAS before she makes the payment on the 2nd of August, and that would work here because she actually makes it on 10th of August. Or no, she can go back and amend her Q4 BAS, or yes, she loses that input tax credit. Okay, so a few less people voting here. I don't know if that's because we're not sure. I certainly need some time to figure that one out. Let's just give us a couple more seconds, and 3, 2, 1, we'll have a look at the responses now. Oh, a few more have come in, that's great.
Terrific that those that have responded have turned their minds to it. So that's right, no, she doesn't lose that entitlement. She can claim it in her September BAS. So reminder, she's a cash accountant. She's actually paid that $1,100 that's referable to June. She's paid it in August. And so her August period falls within the September BAS. You claim the input tax credits as and when you pay the consideration. So she's paid that consideration in the September quarter. It's attributable to her September BAS. So it's good that no one thought she'd just completely lose it, but it is attributable to the September BAS, not to the August BAS.
I mean, we probably all lose it a bit when we're preparing BASs for our clients and ourselves, but...
Yes. Yeah, it can be tricky. It can be tricky, and I know that it can get a bit difficult sometimes when, there's the systems sometimes recognise when things are done being a bit different to perhaps when it's actually happened in real life. So that's where, kind of real-time entry or quite up-to-date, keeping on top of entries into your accounting systems can be really, really helpful to make sure that's done appropriately. But yeah, she doesn't lose that. She can claim it, but she does need to claim it in the next BAS because that's when she's expended the money. That's when she's actually incurred that expense. And I've got one more scenario for her there where we mix up the facts slightly again. So back to the original facts, which are that she lodges her BAS on the 16th of July, I think I put. Yeah, so she lodges her Q4 BAS on the 16th of July again. The only difference here is that she now accounts for cash on a now accounts for GST on a non-cash basis. She accounts on an accruals basis rather than a cash basis. So when she lodges that Q4 BAS, what input tax credit entitlement does she have in respect of this rent for the Q4 period? So she's been invoiced for and paid her March, April and May rent on the relevant dates for each of those months, and the same for July. In June, she's invoiced in June, but she doesn't pay it until 2nd of August.
So those invoice dates, we can assume that's the date that Phoebe was provided with a valid tax invoice.
Right. Yeah.
Okay. Yeah. And then we've still got the same payment dates as we had before.
Correct.
Yeah. Okay. All right. Well, let's go to the quiz slide. So, what input tax credits can Phoebe include in her quarter 4 BAS? So we're back to the quarter 4 BAS. So April, May, June. And are the amounts again counting down? 500, 400, 300, 200, 100. Take off at nil. What do we think? Lots of voting. Everyone seems to know what's going on with this one. Let's see if they are correct. Pretty good.
Yeah. So 300, that's right. So as a reminder, she incurred the consideration and had a valid tax invoice for 2 of those months, which is the same as what she'd had on the cash basis. But the difference here is that late payment it doesn't matter that she paid late. She had an invoice, so that triggers the attribution. The holding of that invoice triggers the attribution, and because it's a valid tax invoice and she's got the credible purpose, that means she can include it in her BAS. So that gives us $300, so 3 months worth of rent for which she can claim that.
Just kind of going back to the facts that we had earlier, once someone has a valid tax invoice, they have up to 4 years to claim the input tax credit. Is that right?
Yes, that's right.
Yep.
So
Yep.
there are provisions which we'll deal with in the final session where we talk about adjustments and changes. There are certain things that don't constitute an adjustment, that are just attribution is later in certain circumstances. And the way that works is if I have an input tax credit that is attributable to this period, but I don't claim it because maybe I haven't put it into my accounting system even though I've actually paid it, for example, and I put it into my accounting system, I can attribute it to the next tax period in which it's actually payable instead. And the way the legislation works is it says it ceases to be attributable to the earlier tax period and starts to be attributable to the tax period in which you actually claim it.
Okay, so I perhaps should have brought it up in the kind of the previous quiz, but that's the reason why we don't go back and amend, or didn't go back and amend quarter 4, why we just made the claim in the September one.
So our attribution remains the same where we haven't paid the consideration in that period. So
right. Yep.
in that early example where she's been
It was on a cash basis, yeah. Right.
if she paid April, May and June on time, so she'd actually paid all 3 on time within that quarter, but for some reason she, maybe her bookkeeper was slow and it didn't get into her zero or whatever in time, and she only claimed $200 of an input tax credit, even though at that point in time $300 would have been attributable. Then the legislation says you didn't attribute that $100. You don't lose it, you just then attribute it to the next one.
Okay, we don't have to keep going back and amending BASs.
Correct.
Yeah, in those circumstances. Okay.
So it is different if you're talking about the commissioner losing out on money. Then there's a different scenario. So if you haven't attributed GST for a supply that you've made, there's a different treatment there. But where you're talking about acquisitions, the commissioner doesn't really care too much if you claim it a bit later. Yeah. And so I'll go into a bit more detail about how to work out whether you've got an adjustment or whether you've got, which constitute an adjustment. The way it works is basically it's a new tax event, even though it's not necessarily a new supply, it's potentially a new tax event. Where you have, where you're just talking about attribution and delayed attribution of input tax credits, the legislation says it's attributable here, or you missed it, let's make it attributable here, you missed it, let's make it attributable here. I'm not sure if I'm showing up the right way on the screen though.
Oh, good.
I don't know if I'm reversed.
Yeah.
But really good
Okay.
question.
And we're going to look at that next week, you said.
We're going to look at that next week in our
Fantastic. All right.
So just these are reminders again. So attribution, if you've got consideration, then that can trigger the attribution for GST purposes. But we do treat deposits separately, and deposits are attributed to the period in which they are either applied as consideration or where the supply doesn't go ahead and the deposit is forfeited. It becomes consideration for a different supply, basically being the supply not going ahead, in essence, is what it's treated as. So where you've got a deposit, it can be treated differently, but you need to make sure it's a genuine security deposit, and there's a bit of detail around that, which includes things like it's the normal amount you'd expect. You can't say here's 90%, let's call it a deposit. It needs to be forfeited in the event that it doesn't go ahead because the purchaser stuffs up something. That sort of the characterisation needs to be a genuine deposit.
So what you're saying there is that the rules normally say that as soon as there's an amount paid or received, it kind of crystallises in a non-cash environment, crystallises the ITC and the taxable supply being reported. But there are circumstances where it's a genuine deposit, it's not actually considered to be consideration.
That's correct.
Right, okay, yep.
So on the recipient side, where I'm making an acquisition, it becomes most relevant for a cash taxpayer, because if I'm paying a 10% deposit, I can't claim 1/11th of that 10% until such time as it's applied, because it's not treated as consideration until that later time.
Mm-hmm.
An accruals taxpayer or non-cash taxpayer that is making an acquisition, there's a consideration aspect, but also if they're already issued with a valid tax invoice at an earlier point in time, that will be both a valid tax invoice and an invoice.
Yep.
So you've got earlier attribution.
Triggered it anyway.
But usually on substantial transactions where you've got a deposit, your supplier is not going to want to trigger it, because then they'll have to fork that money over to their right if they're in a position where they're taxpayer.
So would we have to make a distinction between deposits and instalments?
Yes, so that's absolutely right. Yeah, so deposits and instalments are different. Instalments gives you on the cash taxpayer side gives you consideration, and on the accruals taxpayer side says some consideration, therefore all in, for either your supply being a taxable supply for which attribution is made then, or on the recipient side for being the full input tax credit entitlement.
Yep. Okay, great.
And then just the elements of tax invoices that we've previously discussed, and that's really just for the purpose of putting these into the slides as a reminder. We've been through them in the previous session though. All right. So I just wanted to show, even though we don't really use forms these days, the ATO does still have some of these forms available sort of in sample format, which I thought was useful to just refer to. Usually what you'd see is this information that would then be kind of spat out of your accounting software, and then either automatically input from there, if you have that service connected, into the lodgement database effectively through the ATO. So for me, I do mine personally, so mine actually goes through MyGov, but for tax agents, it can go through their tax agent database that connects directly with the ATO. So it can go either automatically be input, depending on what the accounting software is, or it can be manually input. I'm a bit of a control freak, so I do mine from zero, but I do it on a manual basis. I get it to spit out the BAS, and then I check through everything, and then I actually input my numbers. Given that it's pretty simple in terms of the way that I account for things, it's only a few numbers to put in and check. But I thought it'd be worthwhile bringing these up. So this one here, I've got an example of an annual GST return there, and you can see there that we've got total sales up the top, which is G1, and it notes there it requires 1A to be completed. We'll talk about 1A in a couple of minutes. And G1 says, what are your total sales? So that is sales including GST, inclusive sales, so taxable supplies, non-taxable supplies, so supplies that are either GST free or input tax supplies, they're all included in that amount. So they're saying, what are the sales that you have made, whether they include GST or whether they don't include GST. The next question is, does the amount shown in G1 include GST? So you need to say yes if you've made taxable supplies. If you've only made GST-free supplies and or input tax supplies, then you would be saying no. If you've made a combination and that combination includes taxable supplies, you will be saying yes. Then it gets split down further for some taxpayers. So depending on how you account, you might have this extra information that needs to be put in there. But for some taxpayers, you don't need to. You've got a simplified return that gets done, and you don't need to provide that additional information. So we've got export sales and other GST-free sales there. And then we've got capital purchases and non-capital purchases. So for me, for example, mine's more simplified, so I don't need to distinguish between my capital purchases and my non-capital purchases, but some taxpayers do. The next one I've got is similar, and just to show you a bit of a distinction, this is for quarterly taxpayers, and you can see there that it's broken down into 3 options. So the first is calculate GST and report quarterly. The second is calculate GST quarterly and report annually. And then the third is pay GST instalment amount quarterly. So GST instalments are kind of a little bit more along the lines of your PAYG instalments. Is it PAYG? Sorry, I think that's the right one.
PAYG instalments?
Yeah, PAYG. Yep. Where you can have instalments along the way, whereas the others are more akin to actually reporting based on what you've done, so on your actual activity. And you can see on the left-hand side there, calculate GST and report quarterly. That one has that same breakdown there. And on the right, because there's less information that needs to be provided at that point in time. And then in the final one there, on there we've still got that G1 amount. That's kind of the overall sales, which includes taxable supplies as well as supplies that are not taxable. And sorry, this is not switching slides properly. Here we go. And then the next one I've got up here, this is also the quarterly. This is the second page of the quarterly one. And you can see there the PAYG instalments coming through. There's some other PAYG stuff that I've kind of cropped off so that it's not shown in the slide. It's shown in that right-hand version, but it's not shown in the zoomed-in version. Here, that's where you've got some additional amounts in the summary amounts for amounts you owe the ATO. So GST on sales or GST instalment. So GST on sales for most taxpayers, that will be the GST that you've collected on behalf of the ATO in respect of taxable supplies that you've made. So as a reminder, I always like to think of it as when you're charging GST, you collect it for the ATO, it is never yours. That is the amount that you have collected for the ATO. So for someone like me who will usually just make taxable supplies, it'll be 1/11 of the supplies that I make. If you have supplies other than taxable supplies, so if you also make GST-free supplies and or input tax supplies, then it will be some lesser amount because some of the supplies will be not taxable supplies. So that is the GST on the sales. The sales are included in G1. All of your sales and the GST component is included in 1A. We've then got some PAYG stuff in there, and as you can see, 1A flows through into 8A together with PAYG aspects. And then on the right-hand side there, that's where you claim your input tax credits, so the GST on purchases. So 1B is going to be where you are claiming your input tax credits. That's where you put in the GST that you're entitled to claim for input tax credits. And that's where you need to have all these things that we've talked about today. You need to have your credible purpose, you need to have your valid tax invoice, and the amount that goes in there depends on whether you account on a cash or an accruals basis and the timing of the attribution. So this is where it all ends up being basically just one number at the end of the day. What GST can I claim back as an input tax credit? That goes into 1B, and then that flows through to 8B, and then the net amount that you get is in the payment or refund section where it says is 8A more than 8B, so then your payment or your refund amount goes in there. So if 8A is more than 8B, then you need to give money to the ATO. If 8B is more than 8A, then you have a refund entitlement. As I said, that sometimes can be applied against other liabilities that you have to the ATO. I think it's good to look at these, even though we do it all electronically now. It's good to sort of see how it all fits together. And for my brain, where back in the days when I used to have to do my personal income tax returns from the big tax pack, it's got that familiarity with it as well. But it's good to sort of see how it all fits and how it pieces together. And that can help too when you are doing it electronically and you see those numbers spat out by a zero or whatever it might be. And it also helps when you get to the concept of adjustments and things that we'll deal with in a later session to see how that fits in to work out what your net amount is at the end of the day. So that's really summing it up where we've got to today. We're sort of right on time now. But my key takeaway for today is...
Well, before you get there, Rachel, let's just, I've got a question. So we'll also the feedback poll has come up. So if everyone could also provide rating and a feedback for today's events, that would be fantastic. Do please hop in there any topic suggestions for the future. I noted at the start that Michael did say something about the issue of the agent in terms of whether there's going to be some coverage on that. So just something for you to think about, Rachel, and we'll see if that comes up in a later session. But yeah, please do provide a rating and feedback in the poll that's with you there. Just before we do get to your key takeaway, I do have a question here, and also I do want to remind people that we'll be back on Thursday, won't we, Rachel, to talk more about GST, because of course this one was postponed. So we'll see you in a couple of days' time for another GST basic session, and then we're going to be back next Thursday as well. So in a week and a bit's time for the last session. So do make sure you're registered for those future sessions. And if you've actually just arrived here today, having not attended Rachel's previous two sessions, then of course those replays are available for our VIP and, what's the other one? Team members. Anyway, Stephen's got a question. Maybe you can read it in the Q&A. I will read it out though. How does GST apply to the vendor of a commercial property receiving a premium resulting from a call put option arrangement months before the property is set to settle? What GST is payable on the premium is RCTI by the vendor, and when is it payable given they are accrual basis for reporting GST? Well, that made my brain hurt. Hopefully not yours, Rachel. Is that something you can answer in a minute?
Vendor of a commercial property receiving a premium resulting from a put and call option arrangement months before the property is set to settle. What GST is payable on the premium? So, okay, so I think what they're asking here is that there's a put and call option in place. That means that when they actually sell it pursuant to that put and call option, there's an additional amount that is paid.
I wonder if you might just want to copy that, and we might take that on notice just because of the time and the complexity of that. Does that sound okay?
Yeah, well, I will be talking about put call options in the property section a little bit more on Thursday, so that's probably the best place for it anyway.
Yeah. Great.
But I would like to clarify the question just to make sure I've got the question right to be able to answer that. So it would be, hopefully Stephen's going to be attending on Thursday.
Yes, Stephen, maybe if you can quickly provide some extra comments in there, that would be good. But otherwise, we should finish up just for today. And so what we might ask you to do, Rachel, is to go through your key takeaway.
Yes, thank you. So my key takeaway on this is really that you need to make sure that to be able to claim an input tax credit, your acquirer has a creditable purpose and holds a valid tax invoice. So those are the two sort of most crucial aspects, but also not forget the earlier stuff. So the starting point, the reason I like to start with taxable supply is that if you're acquiring a supply that is not a taxable supply, it's just not subject to GST. So you're never going to be entitled to an input tax credit because there's no GST in there. So don't forget the earlier stuff, but certainly focus on whether you've got a credible purpose and the extent of that credible purpose if it's not fully, and making sure your clients hold their tax invoices to be able to claim their input tax credits.
Thank you. My takeaway was going to be taxable supply first. Before you jump ahead and look at everything else, is it a taxable supply? So, yeah, excellent. All right, well that's 3 GST basic sessions down, 2 more to go. So we will see you in a couple of days. So thanks so much, Rachel, for today. Thanks everyone for coming along and participating. I'll actually be back tomorrow hosting, but Rachel and I will be together again on Thursday. So we'll see you then. Whatever Tax Nuggets Academy webinar you're attending, really appreciate you being there, and also the participation is appreciated as well. Take care. We'll see you soon.
All right.
See you, Rach.
Dạ, chị Ellen ơi, tụi em coi xong rồi tụi em xin phép đi ăn trưa rồi đó, tụi em quay lại nha.